An old friend of mine, Jim Rickards, editor of Strategic Intelligence and author of the upcoming book Sold Out, giving us an international reaction to the turmoil on financial markets here in the UK. Jim, was it all about the unfunded tax cuts, or is this something else happening?
There's something else happening. Now, the UK mini budget is a really big deal. You look around the international monetary system, international economic system, it's very hard to find any leaders or policymakers who actually know what they're doing. But Quarting seems to be an exception. This is the right budget at the right time. Then separately, you have the collapse of sterling and the collapse of gilts. Another big deal. That has almost nothing, I would say practically nothing to do with the budget. I understand there's some contemporaneity. People look at it and say, oh, this caused this. The collapse of sterling and the collapse of budget is part of a global monetary contraction, pending global financial crisis having to do with the dollar shortage. You look around markets around the world, in the UK, but sure, US, elsewhere in Europe. So what's going on? Stocks are down, bonds are down, gold is down, oil is down. You know, the euro is down relative to the dollar, sterling's down, et cetera. You look around and say, wait a second, everything is down. How can that be? And the answer is the dollar is up. The dollar is, you know, if everything's denominated in dollars or translated into dollars and the dollar's going up, it follows that everything else is going down, which is actually deflationary, which is coming. So that has to do with basically a desire to get dollars to buy collateral, specifically treasury bills, to post as margin to support $1 quadrillion of derivatives. And for those not familiar with quadrillion, that's 1,000 trillion. So it has already hit China.
And a trillion's 1,000 billion.
Canada and the UK.
Jim, let's just unpack a little bit of that. This isn't like when you and I sit on podcasts and have detailed technical discussions, which I always enjoy with you, by the way. But what you're saying is that this is largely a strong dollar story. The Federal Reserve, the central bank in the US, has raised interest rates aggressively, 2 75 basis point interest rate increases in a row. Right. Plus, you've got around the world, the South Korean government's taking emergency measures to support its currency. The Japanese government's taking emergency measures to support its currency. It strikes me, and I think you and I agree, that this mini budget was the spark, but it wasn't the cause of these corrections in UK financial markets. What's really happening here is a long-term trend of interest rates rising, of a decade and more of ultra-low rates, ultra-loose monetary policy, so-called quantitative easing that we've had since the global financial crisis. That is starting to come to an end. And as it comes to an end, interest rates everywhere are going to go up. Borrowing costs everywhere are going to go up. Am I wrong?
Well, we'll look back and say that these interest rate increases, and by the way, we've had 3 75 basis point hikes in a row, June, July, and September, and maybe more on the way, maybe another one in November. That is tightening money. It's tightening money at exactly the wrong time. They should back off on that. The central banks are kind of irrelevant. The Bank of England has blundered with this gilts purchase. They made the classic mistake that the UK made in 1992 up against George Soros. They set a deadline. In 92, it was a fixed exchange rate. Here, it's a deadline. The minute you set a deadline in any financial activity, the market trades against you. It's like I'll just short the Bank of England and collect my winnings on October 15th. So that was a blunder, but not unusual for central banks. But you're right about but what I was describing, where I disagree slightly, Liam, what I was describing is independent of the interest rate hikes. Now, those are tightening at the wrong time. That's a blunder. But this dollar shortage, which people have difficulty imagining, say, hey, the Fed printed $7 trillion. How could there be a dollar shortage? The answer is the printed money. And this is true for the Bank of England also. This is why the gilt purchases have no stimulative effect at all, because you buy the gilts from the dealers and then they take the money and give it back to the bank in the form of excess reserves. So it doesn't go into the economy. It doesn't actually do anything. But so these are all forms of monetary tightening at exactly the worst time. People are worried about inflation, and rightly so. The inflation is right in front of us. This is going to turn to disinflation and deflation very quickly, certainly by this winter, early next year. So that's why when I look at Liz Truss and the budget, to the extent that you can get stimulation from fiscal policy, not from monetary policy, but from fiscal policy. That's what she's doing. So looks like as I say, the right budget at the right time. But when I saw the IMF criticize it, I thought to myself, well, carry on. The IMF has been wrong about everything for 25 years. So when they take a shot at the UK budget, I was like, well, okay, you're probably on the right track. But
the IMF's been wrong the IMF's been wrong about pretty much everything for 25 years, says Jim Rickards, one of the world's leading financial analysts, joining there from New Hampshire in the United States.